Netflix reported quarterly financial results after the stock markets closed in the United States on April 17, 2025. The results sent the stock price higher by more than 3% in the hours following the release. Of course, I was happy about that. I've had Netflix stock rated as a buy for a long time now, and I last updated that recommendation a few weeks ago, telling investors that Netflix is a great business selling at a fair valuation. But do I still think that's the case following the company's earnings release? I'll answer that question here. I'll also review the company's latest quarterly financial results, highlighting the big picture items that investors need to know. I'll also share with you again my proprietary discounted cash flow valuation model for Netflix so you can see what I calculated as a fair value for this streaming pioneer. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. So Netflix told investors that first quarter revenue and operating income increased by 13% and 27% respectively year over year. That was ahead of what they told investors they were going to achieve. So Netflix told investors they were expecting a certain number for revenue growth and operating income. Those numbers were beat by the company's actual performance. That's good news, especially because the first quarter was a volatile part of the year as the United States and President Donald Trump started increasing tariffs and consumers started pulling back ever so slightly ahead of these tariffs and worries about an economic recession. So it was good to see that Netflix's business held up really well amid this economic uncertainty. And of course, that's one of the reasons why investors are very excited about Netflix stock right now, because they expect it will perform well even if these tariffs remain in place longer term, because Netflix does not sell any physical goods and Netflix's monthly premium is relatively cheap when compared to consumers' overall budgets. And so if consumers are pulling back on other things like buying a new iPhone or taking the new trip or taking a vacation, Netflix will consume more of people's budgets. On April 1st, they successfully launched their ad tech platform in the United States and are on track to roll it out in their remaining ads countries in the coming months. Of course, Netflix only recently started adding advertising to their business model, and in recent reports, we've heard that over half or roughly half of new subscribers joining Netflix are joining through the ad-supported tier. But this ad-supported tier is under-monetized for Netflix because they're just rolling it out. It hasn't even been 3 years that they've rolled out this ad-supported tier. So they're still learning how to monetize this most effectively, and it's still growing robustly. In this report, Netflix's management team told investors they expect their ad revenue to roughly double this year from the same time last year. That's how quickly this business is growing, and that's how early stage its ad business is. Surprisingly, Netflix did not upgrade their revenue or profit outlook for 2025. I think with this great start to the year, investors would expect that Netflix would raise their targets for the rest of the year because they started off so strong. But I think Netflix's management team is taking a cautious approach to guidance, given the factors I highlighted earlier in the video. They also probably see these macroeconomic circumstances and they do not want to raise their guidance ahead of a potential economic recession or slowing worldwide economic growth. So no change in their 2025 guidance. They still expect revenue of $44 billion and an operating margin of 29%, even though they generated much better margins in the first quarter and are expecting much better margins in the second quarter. So what's implied in this forecast is that Netflix expects a slowing second half of the year because the first quarter was excellent. And I'm about to share with you what they expect in the second quarter. So if they expect a really strong second quarter and the first quarter was strong, that means they're expecting a less than stellar second half of the year. So I highlighted the first quarter was strong, revenue growth of 12.5% and operating margin of 31.7%. They're forecasting accelerating growth in the second quarter, with revenue increasing by 15.4% year over year and an operating margin of 33.3% for the second quarter. So combined for the first 2 quarters of the year, the operating margin would be over 32.5%. But for the full year, they're still forecasting an operating margin of 29%, even though they're starting the year with an operating margin over 32.5%. So what's implied there is they are expecting the second half of the year to have an operating margin of around 25%, which is one reason why investors were not more enthusiastic about Netflix's stock following the earnings release. I mean, it was up over 3% following the earnings release, but it would have been up by much more than that had management given an upgrade to their guidance. There's also a bit of gamesmanship here. I don't believe that investors fully expect Netflix's second half of 2025 margins to be that much lower, but they also understand that Netflix's management team needs to incorporate the potential economic recession in the second half of the year. So they've just incorporated the probabilities of a recession into their forecast. But if there is no recession and we end up skipping a recession again, remember there was fears of a recession in late 2022 and we skipped it, we didn't actually have a recession. If those fears again turn out to be more than a reality, just a fear, then Netflix's performance is likely to be much better in the second half of the year than what the management team is forecasting. So I updated my discounted cash flow valuation today following the earnings release, and I increased the intrinsic value per share by about $20 from the previous forecast, from the previous calculation. I now have Netflix's intrinsic value at $919 per share. The current market price is $973 per share. Of course, this is before the update following the earnings release. This Google Sheet here updates Netflix's market price automatically during trading hours. So since it's not during trading hours right now, it's a holiday here in the US on Good Friday, the market price hasn't adjusted upwards. It will on the first trading day on Monday. So according to my intrinsic value calculation, I think Netflix stock is still fairly priced, right? The difference between the market price and the intrinsic value per share is not large enough for me to say it's overvalued. I like to incorporate a margin of safety there. And so I would say that the business is fairly priced. And of course, you've heard me talk about how I believe Netflix is an excellent business. And I'm always interested in buying an excellent business at a fair price. I think that's a great deal for long-term investors. So to update my recommendation, of course, the last time I updated Netflix was on January 21st, 2025, where I reiterated my buy recommendation for Netflix stock. And I'll update that recommendation today, reiterating that I believe this is an excellent business for long-term investors to buy and hold. Hey, everyone, I'm excited to announce a brand new private Discord for our channel members at the VIP Discord level. It's a great place to connect with me directly, engage with like-minded investors, and learn more and take your investing to the next level. Spots are limited, so join now before it's too late.